I, Margav Shukla, welcome you all in this special session which we have hosted post the budget which was introduced on 1st of February 2025 by our Honorable Finance Minister. This is an In.Talks webinar wherein we keep educating the participants, clients, everyone on the new things which are being introduced. The topic of today is the Union Budget 2025. So we have all the learned speakers having specialized area of service which they cater, and they'll throw light on the various amendments which have been brought about in the Finance Bill 2025. First of all, I would like to introduce InCorp. We all know what InCorp is. We are more than 2,500 plus professionals having more than 50 plus services and serving across 20 plus APEC offices across the South Asian region and across the globe. It is backed by Hill House and it is forming part of an Ascentium group. Apart from that, I would like to introduce first of all myself, Margav Shukla, working with InCorp for more than 10 years. I lead the direct tax practice. Now, moving on to the topic, moving on to the subject, which is the Union Budget 2025. As we all know that there are various amendments which have been given. And just to set the context right and to start with the thing which everybody liked about the budget, which is 1 lakh crore of revenue, which was foregone by our finance minister, which is on account of increasing the slab rates, which was always dreamt of, but never done. So she has increased the slab rate up to 12 lakh of rupees. But as we all know, income tax is a very simple law, has its ifs and buts, has various provisos in place. So this also has one, especially with respect to incomes in relation to the capital gains income. So we'll discuss various other things as well. Moving on, I would like to introduce our first speaker, Mr. Bhavesh. He's having more than 27 years of experience in international taxation and FEMA, has been guiding various residents, non-residents doing international transactions. And today he's going to throw light on specific amendments which shall affect residents who are doing businesses with non-residents and non-residents who are doing business in India. So let's hear it from Mr. Bhavesh. What are his views on the budget that has been floated and how it will affect the way business is done? Bhavesh, if you can start.
Sure. Thanks, Margot. Thanks for the introduction and kind words. I think my first initial feeling is that it's very progressive and a forward-looking budget. If you see the entire context and the fabric of the way the budget has been put up, there's a feeling that...
Sir, you've gone on mute. Bhavesh, you've gone on mute.
Oh, sorry.
Yeah.
Okay. So I was saying it's very progressive and a forward-looking budget. I think if you see the overall context and the fabric of the way the budget and the provisions has been laid down, there is a constant feeling that India is reshaping its fiscal framework around the philosophy of self-reliant or Atmanirbhar Bharat. There is tremendous push to manufacturing sector, a lot of provisions encouraging domestic manufacturing, which overall aligns with the larger approach and the motto of Modi government of Make in India. We'll come to the details, some of the details in a later part. But to name a few areas which were untouched so far, I mean, to give an example, there's a announcement to make India a global manufacturing hub vis-a-vis toy manufacturing industry is concerned, or shoe manufacturing industry is concerned. These are the industries which have not been looked upon or not been touched upon in any of those previous years' budget or any policy paper, so to say. But now to think about those industries and make them a global manufacturing hub is a bold step in the direction to make India as an overall manufacturing hub. This underpins with the fiscal prudence as well, because they have maintained the fiscal deficit at 4.88% in the current level, as well as 4.4% is expected to be a deficit in the subsequent financial year. So there is a huge emphasis on fiscal consolidation and government spend that is likely to incur in the coming years. Moreover, there is an announcement on setting up of a committee for non-financial compliances to overlook non-financial compliances. As we know, India has been heavy on compliance, and domestic as well as international community feels the pinch of heavy burden of compliance that comes along with the doing business in India. So there is a commitment to go from heavy to go light touch compliance burden, as well as the announcement of decriminalizing over 100 plus non-compliances that will also go a long way in ease of doing business in India. That's a right step, because facing the criminal prosecution is the last thing any businessman would expect for some bit of a non-compliance that may encounter during the course of business activity. Along with this, there's a welcome announcement of laying a new finance bill, a much awaited announcement, something which finance minister announced in the last budget. It is hoped that the new bill is simple and very concise. This also lays the shift in the overall approach of the government from trust, where earlier the concept was everything that you do is we'll have to look at it with a microscope, and now there's a light touch approach where trust first and scrutinize later. A very important shift in the structure and the approach in which the authorities would now look at the businesses and the assesses. Very important, which gives the business community a much required confidence that there will not be an unnecessary harassment from the authorities. In the same breath, there is a simplified version of tax law. If you've read the Economic Times of today, the CBDT chairman announced that the new tax code will be a very simple format, a simple language, easy to understand and less complicated. Let's go for interpretation. We only hope that this is done in the right spirit and letter both, so as to achieve as the overall target of making India a non-litigative country, because we've been ranked very high on tax litigation index across the world. So I think, Margav, these are my initial 2 cents on the budget for you. Thank you.
Thank you. Thank you, Bhavesh. That was actually insightful. As you mentioned that trust first, scrutiny later, Finance Minister had mentioned some days ago that 99% of the returns will be processed on trust basis and only 1% will be selected for scrutiny. I think that is the path which we are upon. Moving on, we have with us Mr. Samir, who has an experience of more than 20 years leading direct tax, transaction advisory, and family office business. So let's hear from him. We've already heard what non-residents, how the budget will impact them. Now let's understand what are the implications, the first reaction to the budget when it comes to the residents under the direct tax. If you can throw some lights up.
So thank you, Margot, for introduction. Budget to me is like, it looked like a citizen first budget, but actually it scripted the transformative story of building the strong foundation for global leadership. I have my 5 key takeaways from this budget, which laid down the roadmap for 5 years with the certainty amongst all of us. First is Make in India. From Make in India to Make for India. Key infrastructure push through public-private partnership. Strengthening MSME ecosystem. Technology disruption through innovations and the startup ecosystem. And financial inclusions for the selective segment of the society. If you read all these 5 points together, the crux of this is like, India is moving towards the global hub with excellence by taking some key initiatives like deep tech funding in innovation, clean tech, as well as nuclear energy missions, which will make India a global hub for excellence. Similarly, global capacity centers is designed in tier 2 cities across the country, which shall drive the decentralization of the economy and creation of the regional jobs. India AI Mission funding an AI Center of Excellence shall make India the tech-first nation. Focus on climate-friendly development, nuclear energy solutions with the nuclear reactors manufacturing by Indian players shall push the skill-based programs will make the industrial competitiveness in the global supply chain. Most important is tax clarity and investment-friendly climate for foreign participation to come in India, which will bring long-term capital in India with the strategic value proposition. Even regulatory ease as well as the tax certainty for the investment held by the AIF, business trust, or even the foreign entities operating in GIFT City, IFSC Center will foster the long-term growth because of the tax certainty and clarity. The one game changer step or budget move is attracting the international talents with the tax certainty for pushing Make for India, which we could sense in this budget for EV and semiconductor industry, which was the much needed initiative. But I feel in future this will be across the other segment and other sectors of the industries also. Right push for labor intensive industries like leather, footwear, toy, as well as heavy capex industry like shipbuilding and cluster development shall create a labor focused industrial ecosystem and shall secure the more jobs with social harmony. Raising MSME threshold with from current level by 2 times of investment and 2.5 times of investment and 2 times of turnover shall help more participation in the public procurement, and further tax rationalization measures shall build trust for all and ensure ease of doing business with least compliance cost. And most importantly, tailored financial solution and credit guarantee cover extension to drive confidence amongst the MSME and startup ecosystem, which will go a long way. In essence, the budget 2025 lays down the foundation for progressive and self-reliant India with impetus on the innovation, positioning India for the sustainable growth, global competitiveness, and inclusive development, which shall make India a Viksit Bharat in reality. Over to you, Margav.
Thank you. Thank you, Samir. So I would, since you've given the brief introduction about how the budget is placed, I've always heard this term called as ease of doing business. I want to understand with this budget how ease of doing business will happen in India, because budget is the place where, as far as the direct tax provision are concerned, we look forward to. We hope that some things will be resolved, compliance will be reduced. You also mentioned in your take that some compliances are done away with. Can you share your views on how ease of doing business will be applicable?
Yes, definitely. And one change can bring multiple ripple effect, which we always heard, but this is true in direct tax case today. As you rightly pointed out, the personal taxation reliefs and the marginal relief concept, which is introduced and the threshold is increased to 12 lakhs, which affects the pocket in a positive way. But at the same time, there are lots of compliances provision have been relaxed or done away with, which makes the compliance cost even lower. Like the TDS threshold is increased, and this will boost the taxpayer trust in the system, and at the same time the individuals with the income below exemption limit will not require to file return only to claim the TDS refunds. The another game changer point was the TCS on sale of goods, which is scrapped in this budget, and already we were having a TDS on the similar situation. Now TCS is done away with, so this will be a substantial reduction of the compliance and cost. for the businesses. The other important point is higher withholding tax, which is now restricted only to the non-PAN holder, not the non-filer, which demonstrates the trust and transparency. Instead of verifying the deductees having not filed the return, now it is done away with, and now it will be only for the people who are not holding PAN will suffer the higher tax rate. The one important tax clarity and certainty which came out of this budget is about the sunset provision for the startup, which is extended by 5 years, and that brings the confidence amongst the startup entrepreneurs as well as the employees of the startup if they want to defer their tax liability based on the ESOP pool. So these are my takeaways as far as the ease of doing business is concerned.
Thank you, Samir. So I think some measures which will impact long time TCS and are the welcome moves from the government, certainly. Moving on from direct tax, we have with us Mr. Milan Shah, who is heading indirect tax business, has been with InCorp since more than 17 years, specializes in GST and service tax matters. So Milan, same question to you as well. How indirect tax, which is the goods and service tax or goods and simple tax, which it was supposed to be, introduced in 2017, how budget makes lives easier?
So, hi Margav, and good afternoon everyone who are attending this webinar. Margav, generally Union Budget does not have surprises as far as GST is concerned, because we keep on getting surprises 4 to 5 times every year through GST Council meetings. Normally, whatever changes in GST come, they come through GST Council meetings. In just December 24, 55th Council meeting was held. So you can imagine 4 to 5 times we are facing the budget every year. So nevertheless, having said that, there are certain important amendments which were proposed in the 55th Council meeting, which was done in December, which are worth to be discussed because they might have impact on the business at large. So I'll take a couple of them. One is with respect to ease of doing business, of course. So we'll see how it is ease or what is the actual implication. One is with respect to credit notes. This amendment in credit note actually impacts almost all the businesses, because raising credit note is a very normal task for any business which is registered in GST. So till now, the supplier of goods or services was able to reduce its output liability by raising a credit note on its GST portal. Though people are unaware that there was a provision in law that we can take the benefit of credit note only if the recipient has reduced its output liability. But there was no functionality on the portal. So what used to happen is, when department at the time of auditing the clients, auditing the SSEs, they used to question whether the recipient has reduced their ITC. So this was kind of an harassment which was going on. So in this budget, they have come out with the amendment to credit note that if the recipient explicitly either accepts or rejects the credit note, then only the said credit note, effect of said credit note can be given. Then only the benefit can be taken. So in one way, it is a reduction in the harassment from authorities level, but the manufacturers or the supplier of goods or services will have to take an additional burden in case their recipient does not file their return properly, or in case they reject a particular credit note. So there are chances that a compliance may be increased, but at the end, the harassment will be decreased from GST audit point of view. One more very welcome change is with respect to vouchers. They have now clarified that there is no GST applicability on the vouchers. See, this has been the 8th year of GST. And after 8 years, we are giving a clarification that GST is exempt from vouchers. But whatever it is, finally a circular has came and it is said that voucher cannot be treated as goods and cannot be treated as service. Vouchers are actually a money or an actionable claim, and both of are outside the scope of the supply. Hence, GST should not be applicable on the vouchers. One more very important thing, though may not be connected with ease of doing business, but which may affect many of the businesses, which I would like to draw upon, is input service distributor. Now, many people, from 1st April 2025, the input service distributor has become mandatory. So it is it is applicable to businesses which are having more than 1 branches, maybe 1 branch and 2-3 head office, 1 head office, 2-3 branches. Or similarly, maybe a couple of branches within the same state, but which have different GST numbers. So what happens is there are some type of common input credit like a chartered accountant fees, or maybe software purchase license, or maybe advertisement services or legal services. So the point is only one particular branch should not avail the benefit of that entire ITC, that invoice. It should be distributed to all the branches which has taken the benefit of that particular ITC. Now in this budget, they have also specified, they have gone a step ahead, that even the GST which is paid under reverse charge basis needs to be distributed to all the branches. So this was inserted in this particular budget, that RCM should also be distributed. But entire ISD will come in effect from 1st April 2025. So all the businesses are advised to just start taking registration in case this ISD is applicable, so that April 25 is not far away. So that these were some basic amendments which were related to GST, which might impact the business at large. Margav.
Okay, correct. Quite of them. Businesses having GST numbers should be active, and they should know what next steps to take.
Correct.
Moving on, I'll move on to take Bhavesh's view as far as the international tax is concerned. We've seen direct tax as far as the residence is concerned. We've seen GST. Moving on to international tax, there has been business connection definition in Section 9 for a long period of time. Then thereafter, there was significant economic presence which was introduced in Section 9. Section 9 is one topic which most of the people stay away from. And there is one more amendment which has come. So can you throw some light on how this will, whether it will ease the business or it will unease the business?
Thanks, Margot. Thanks for asking this, because as you rightly pointed out, every non-resident is fearful of Section 9(1) provision, because they've created a deeming fiction, creating their income deemed to accrue or arise in India. So as a part of Section 9, where income of non-resident is deemed to accrue or arise in India, there is another concept called business connection. And by virtue of non-resident creating a business connection in India, their income stands taxable in India, which is a deeming fiction introduced, which has been on the statute for quite some time. Now, somewhere in 2018, before that, there was a carve-out for non-resident, that as far as activity of non-resident, which is restricted to supply of goods to India, which we typically call it an export carve-out. So only if they're exporting goods in India to an Indian importer and doing no further activity, so even if they are earning income from India, their income would not be deemed to accrue or arise and would not be subject to Indian taxation. Somewhere in 2018, as a part of BEPS project under OECD auspices, Action 1 was set out, and as a part of Action 1, there was a need to tax the digital services company. While those provisions only related to export of goods from outside India, a lot of companies which provided services digitally were escaping the tax net. And to arrest that digital taxation, there was a concept of significant economic presence that was brought on the statute, which laid down a certain threshold limit above which, if the activity of supply of goods or services were concerned, if the activity breached those thresholds, then income of non-resident would be deemed to be taxable in India by virtue of creating a significant economic presence. Now, this led to an unintended contradiction between the provisions of SEP and export carve-out, because under export carve-out, there was a specific exemption provided to a non-resident, whereas significant economic presence laid the condition where income of non-resident would be subject to tax in India, even if it relates to supply of goods. To overcome this genuine hardship and maybe unintended, the unintended conclusion to the entire matter, the need was felt that we need to simply exempt the export of goods to India and not tax the non-resident entity if their activity is restricted only to export of goods to India. And that's why this provision has been brought on statute to clearly exclude and bring a uniformity and harmonizing the tax law to ensure that no exporter of goods to India is harassed and brought to tax unnecessarily, because that is what not the intention of the government or the income tax department is. So to bring uniformity between the provisions and to overcome the hardship created by the SEP circular, the amendment has been made to ensure that activity restricted to export of goods shall not be liable to tax in India, and there will be no deeming fiction applicable on those activity. So I think it's a welcome move, welcome provision, much needed clarification brought in the statute. Margav.
So basically a positive amendment. No TDS requirement, 15C CB requirement was there. Now the clarity also that there will be no taxation as well. So
Right.
certainly a welcome move. Hope this section 9 is a simpler section 9 in the new bill to come. We can all hope for that. Yeah. Moving on, we continue the theme of ease of doing business, and we move on to the GIFT IFSC, which is a special zone which has been created by India, and for which we have a GIFT City expert with us, Meet, who has been there. He's understanding what the problems of the new GIFT which has been established. What are the provisions which keep changing, keep introducing? So we'll hear from Meet. He has more than 10 years of experience. Now I would like Meet you to address how ease of doing business can happen in GIFT with the provisions which have been introduced in this budget.
I think a budget has brought a lot of clarity in terms of GIFT operating as an IFSCA, IFSC jurisdiction basically from India mainland, and it is differentiating itself from the other financial jurisdiction available around the world and around us, be it Dubai jurisdiction or Singapore jurisdiction or Hong Kong jurisdiction. In that case, a lot of key amendments have been brought in. Just to give a glimpse of it, we saw amendment in life insurance policy exemption, which was brought for NRs. There was a shipbuilding lease activity, capital gain and dividend angle, which has been clarified, which are on the same lines as aircraft leasing. There are certain amendments brought in to showcase the strength of the span of the 10 years tax holiday by extending it to the 5 years rather than an annual extension. So overall, these amendments are going to be appealing to domestic and international businesses overall and helping them to expand their business in the right fashion. Also, this tax saving schemes that have been brought in for different regulations will provide a lot of clarity to the businesses. And on a specific note, when it comes to the deemed dividend provisions for the global treasury centers, you will see because of the loan transactions happening between the parent company and the subsidiaries which are set up in GIFT, etc., there was an angle of deemed dividend when the asset keeps outstanding at the balance sheet date. You would see a tax impact, and I think that's have been clarified in the recent proposal in this union budget.
So basically what I understand that there is certainly a gift which has been given to the GIFT entities this time.
Correct. With the rationalization of provisions, of course.
Correct. Hope more and more rationalization comes and it is made more attractive to achieve the objective which our Prime Minister had. Moving on, let's talk about the new provisions which have been introduced, because we've heard about how the ease of doing business has happened. Now let's understand certain new provisions which have been introduced. And I would like to start with Bhavesh. This is very new, Bhavesh, because presumptive taxation we all know was only applicable to resident, and non-residents never had this benefit of presumptive taxation. Whereas non-residents always wanted to say that I don't want to maintain books in India. I want to do business with India because it's a growing economy. So now presumptive taxation for non-residents, this is something that I've heard new. Can you share your insights, how it will work, what is it, how it will benefit?
Yes, Margav. I think this is another step, in the direction of Atmanirbhar Bharat, or Make in India push. That government has set up a program for electronic system design and manufacturing hub for developing semiconductor and display manufacturing. So typically the incentive is provided to entities who provide systems, designs, technology for electronic manufacturing to Indian entities. Typically, the way they work is the designs are owned by the foreign entity, it is being provided, the intellectual property in the design is held by the non-resident entity, and it is granted to an Indian manufacturer for designing purpose. Along with that, they also provide an additional services of technology transfer, the chip design, or they call some kind of a technical know-how. The way this works is Indian entity would avail those technology and make a payment towards a royalty, or sometimes it may be classified as fees for technical services. Now, royalty or fees for technical services were always taxable at 20% plus surcharge cess under the Indian domestic law. This was obviously a very high rate of withholding that would incur at the non-resident level, because roughly around 24% of their remittance would be withheld by way of tax deduction. To promote this industry, the need was felt that the government needs to have a rational tax regime for non-resident entity to be able to provide the much required technology in semiconductor and system design industry, making India again a hub for electronic manufacture. And that's the intention of this provision, where income of the non-resident, let's say if the Indian company has to remit $100, 25% of the remittance would be construed as an income. So $25 would be deemed to be an income of a non-resident, and 35% tax rate would be applied on the 25% income. Effective tax rate would be roughly around 8.75%, which is far below any of even the treaty rate provided under the various treaty that India has entered into. So non-resident obviously has a option either to go under the presumptive tax regime and offer a tax of below 10%, which will be much more lesser than the treaty rate of 10 or 15% generally entered into by India with a different jurisdiction. And also have the benefit of stable tax regime, because once you offer the taxation on a presumptive basis, you are not required to maintain any further books. You're not subject to any other questions, so to say. So it gives a lot more stability in their operations as far as India is concerned, and that's why it's very, very beneficial. Now, there could be one adversity to this is some of the companies may not be operating at such a high margin. So maybe it's a business call that one will have to adopt, whether to go under a domestic law and have a 8.75% tax obligation on the remittance, or take a treaty advantage and claim a tax relief in the home country. So it's a fact-based assessment that every company will have to do. But on an overall basis, it's very favorable presumptive tax prescribed for non-resident, backed by a very stable and favorable lower tax base, so to say. So it may again a beneficial provision for non-resident for them to go by this lower tax regime.
So the experience for residents also has been very good as far as the presumptive taxation is concerned, because there are less of questions, simplicity of returns, no maintenance of books. So I think if it can be extended to more and more sectors, even for non-resident, that will attract more non-residents to India, and the business will get eased, I think, as far as that provision is concerned.
Rightly so.
Correct. Moving on to GST part, as far as the new provision is concerned. Milan, I would like you to address that there are various new things which has come up in last 8 years. Every time there's something new which comes up, like invoice management system, e-invoicing. What is new this time around?
So this time the government has introduced the system of track and trace system. See, normally they have used the word unique identification marking. So the government is going to come out with some specified product list, which will have to follow the unique identified marking. So this is required in order to monitor the flow, the control of the supply of such particular goods. Basically, these goods are of high importance. Maybe they are prone to more tax evasion and they are of high tax rates. Generally, though the list is not out, but we assume that it would be relating to cigarettes, tobacco, maybe some pharmaceutical items, or gold. So this unique identified marking is going to a kind of a digital marking, which would be affixed on the product, or something unique logo, which cannot be removed from the product. So, and they have mandated very strict penalty for not following this. If you don't follow this rule, then there will be a penalty of 1 lakh rupees or 10% of the tax payable, whichever is higher. Generally, normally, still, even after 8 years, the scenario of fake billing is going on, the tax evasions are going on. Hence, the government is bound to come out with this new systems, which is going to create an issue for normal or good manufacturers, but at the cost of others, they will have to bear. See, point is there will be an additional compliance with respect to the right from manufacturer to the entire supply chain for maintaining records of some such type of unique identified markings. So yes, this is a new thing in order to curb the tax evasion, which the government has proposed now. This is a kind of googly, but let's see how it works practically. Yeah, Margav.
So I understand one more thing to be read, understood, and learned. Track and trace.
Yeah, it's track and trace.
Moving on to the new provision, it is with respect to IFSC. And we have with us our guest speaker, Mr. Sandip. I would like Meet to give a brief introduction and take it forward, Meet.
Thanks, Margav. Hi, Sandip bhai. We welcome you. Sandip bhai, as an introduction to all, he is the head of IFSC department at GIFT City. He is a 40 under 40 investment professional awardee. He leads various initiatives with GIFT Authority, IFSC Authority, and other Ministry of Finance and other ministries. He's playing a very key role in attracting a lot of businesses, including foreign universities in GIFT. Sandip bhai, just your first insights on the budget and its outcomes. How do you see a few amendments? We will talk about it in detail as you go on.
Sure. Thank you very much, Meet and InCorp for organizing this webinar today. I'm sure the participants will benefit with the deliberations today. I think overall budget, we all know that the consumption story is very much aligned to the incentives that they've kind of introduced, and we are very much sure that it will have a multiplier effect in the overall economy. Plus, in spite of various constraints, the focus has remained for the capital expenditure, by the government, and that capex will again will ensure that the growth will continue, and we will remain one of the largest, and the fastest growing economy overall. Uh, Specific to GIFT City, I think the benefits have kind of have come through for various sectors, including corporate treasury operations, the fund management as an ecosystem, aircraft leasing, and ship leasing. So I think there are 3 to 4 sectors which have been very well captured in the announcements of the union budget, including in the finance bill, and we are happy to kind of get those amendments, because that will actually drive some of the new businesses that we had not seen in past, and we will actually deep dive into that each of those announcements, but probably for each of those business sector, it will actually kind of create a new value business propositions. Many of these initiatives are also leading to creating a new and innovative products, and that's where with the added tax advantage, it would be very easy for the companies or institutions to now innovate in their products, and then attract foreign investors to through the GIFT City ecosystem. So overall, very welcome move for GIFT City. I'm sure many of you know that the various incentives have already been announced in the past budgets. I think 10 years of income tax holiday under the Section 80 LA, withholding tax exemption, capital gain tax exemption for the securities traded on IFSC exchange platform. So I think the larger benefits were anyway available, but with this new announcements, I think it has given a momentum to the new lines of businesses as well. I think we can deep dive into the each announcements and discuss accordingly. Yeah.
Couple of questions for Sandeep. So we have seen an amendment on the life insurance part, where the speech was something else versus the actual bill. So a question to you: what is the amendment about? Whether it is applicable only for non-residents, or is it for residents? Any insights that you want to give for life insurance intermediaries who can sell such policies from IFSC Gift?
Thank you. I think insurance is one of the sector which required kind of some push to kind of develop and promote from GIFT City. The reinsurance as a sector has already grown. I think there are a good number of players, including a couple of global insurance firms have also set up. But the next move, basically, which was required was for the life insurance sector, because as we all know that the Indian diaspora or the NRIs overseas, I think the number may go beyond 20 million. Now, how do we solve their insurance requirement using the GIFT City kind of structure? And that's where from a regulatory perspective, it provided a very well defined regime to kind of issue dollar denominated insurance policies to the NRI customers. And what was kind of missing, because when a non-resident was availing insurance policy from GIFT City, the proceeds received from that policy was taxable in the hands of non-resident investors. Now, that was not the kind of an efficient regime, because globally, if they would have availed such policy from other global insurance company, that it would not be taxed in the hands of non-resident investor. So I think the jurisdiction is now at par with some of the other global centers. And I'm sure many of you know HDFC Life India First. They've already established their insurance office here, and this benefit will now help them to now market and promote the insurance products to the global investors. uh, our understanding is that this benefit will be applicable to the non-resident investors and not the resident investors. And that's where the product will now be kind of marketed to the NRIs now.
So I think a lot of registered intermediaries, 2025 intermediaries at least, will have something good to see from this budget. I move on to the next question. Margav, yeah. Yeah, so the next question was regarding the ship leasing alignment. Similar benefits are available for aircraft businesses. Now, the same has been announced for shipbuilding players. Can you throw some of your insights, particularly on how this amendment will work in terms of building up the ship leasing business from GIFT IFSC?
I think the budget has provided. We all know the focus on the maritime as a sector as a whole. I think the maritime fund has also been announced in the budget, that they plan to create a dedicated fund. The announcement was also around creating a shipbuilding ecosystem in India, because we have realized the importance of creating our own shipbuilding ecosystem in the country. And in the entire ecosystem, I think one of the important aspect is to also provide ship leasing ecosystem. GIFT, in last 2 to 3 years, the committee was formed. There was a 360-degree kind of study of ship leasing as an ecosystem, and the various benefits were anyway kind of announced and provided in the past, in terms of the tax holiday, as well as the custom duty related benefits and tonnage tax related benefits. But probably, as we know that the business, the way it operates, because of the high value nature of the ship or the asset, they create special purpose vehicle for each asset generally. And when those SPVs are created, many times when they sell those SPVs, there was applicability of capital gain tax. So in spite of I'm part of a 10-year tax holiday, but I may have to pay capital gain tax because of the nature of the structures that they create. Similarly, if the SPVs are paying dividend to their parent, which is again within GIFT City, even that they make that become taxable, basically, in the hands of the parent, or maybe the parent is overseas, it may become taxable. So probably idea was to now create an efficient structure, because some of these provisions uh, would not apply to such structures where multiple SPVs are created. And that's where these two benefits will now make it GIFT City Center at par with the other global financial centers. And We have already, more than 15 such firms which have set up as a ship leasing firms, and many of them have also leased from GIFT City. But the scale will come once these benefits are extended, and such multiple SPVs will now come forward and will create a larger market to support the India's requirement. Eventually, India is a large country, and we may also be able to offer ships on lease to the other global centers as well, so Asian market or a South Asian market. But our own demand itself is so huge that eventually our leasing companies we will be able to offer it to the Indian companies.
Thank you so much for that insight. Last question. How do you look at this 5-year expansion to the tax holidays rather than an annual extension, which has been provided? A quick bite on it.
No, I think the annual extension, which was extended 2 times in last 2 budgets, but by the time they make up their plans, they were not sure whether they will be able to complete in a 1 year's time, and that's how they were always on the fence, because they were not sure whether they will be able to complete the entire transaction by March 25 or so. And that's where idea is not to discourage in terms of the incentives that they get, but idea was to kind of attract them on priority. So with 5 years window now, it kind of gives a clear timelines in terms of understanding the modalities, technicalities involved, because these timelines applies to say a relocation of a fund. It applies to establishing aircraft leasing as an entity. So the investors will now be able to take a longer term view, longer term perspective for establishing their presence here. It's important to note that it doesn't apply for, say, Section 80LA tax benefits, as mentioned. This only applies to a very specialized transaction and businesses. So, we take it it as a very positively, and a 5 years window is a good enough for taking a decision. And, it would encourage more such players to look at it now.
Thank you. Thank you so much for your deep insights. I hand over to Margav to complete the other set of questions. Margav, you are on mute.
Thank you. Thank you so much, Sandip bhai, for giving the deep insights in the IFSC and the amendments which have been brought in by the budget. Hope it will ease doing business in IFSC and attract more investments therein. Thank you. Now, moving on to the last segment, which was the major amendments part. So, as far as the GST is concerned, Milan, can you throw light on what are the major amendments which has come in, especially with regards to all the controversies which we have seen basis the order of Odisha High Court and then the order by Supreme Court. So, can you throw some light on that?
Yes, Margav, actually this amendment to Section 17, which is a kind of block credit. So this amendment can directly be compared to a Hindi phrase which is called Hindi proverb, maybe हाथ को आया मुंह ना लगा. So actually ऐसा हो गया, since last 5 years the litigation was going on, and finally in this Odisha High Court and then later the Supreme Court in Safari Retreats decided, and they gave that ITC on construction of immovable property. If it is directly relating to leasing out, then the same can be availed. Indirectly, they told that immovable property, that is a building, can be considered as plant. So the entire issue was on the interpretation of just 2 phrases, plant or machinery and plant and machinery. The legislature has given the definition of plant and machinery, and it does not include building. So, but there is one more clause under Section 17(5)(d), wherein they have used the word plant. If construction is relating to plant or machinery, then it is allowed. So in this particular case and also in various other cases, they have taken a stand that our building is a plant and plant is not defined under the Act. So as per General Clauses Act, a building can also be considered as plant, and on that basis, the entire decision was given by the Supreme Court. However, with this budget amendment, the amendment to Section 17, this amendment nullified the decision of the Supreme Court and has given a clear message that what was not intended to be given by the government cannot be taken from them just by on account of playing or on account of some wrong words, wrong conjunction used in the legislation. So they have got a step forward and they have just written in that particular amendment. This is irrespective or notwithstanding any notice, any decision, any decree, any order given by any court. Wherever the term plant and machinery is used, plant or machinery used, it should be treated as plant and machinery, and which does not include building. So see, generally ITC on building was never supposed to be given, but on account of some error in the legislation, the industry thought that it should be given, because logically, if the entire building is constructed for the sole purpose of letting out, then ITC should be given. Logically, it should be given, but if the act says, no, I don't want to give ITC on construction, then we have to follow the act, and this is how it is coming out. Margav.
So I think this is something which reminds me of Section 9 retrospective amendment, which had happened after Vodafone's case, wherein they had won up till Supreme Court, but then we had a retrospective amendment, something similar to that.
Yeah, it's very similar to that.
But I think, as you were saying, that was never the intention, so the law has changed. Moving on to the major amendments in direct tax, I would like to understand from Samir. Charitable organizations has been one of the favorite topics of this government, wherein in last 4 to 5 budgets, there has always been an amendment in this case. So whether this time it is for the benefit or it is adversely affecting them.
This time, this amendment is for the benefit, for a change, and
it's certainly a big change.
Yeah, it's a very big change. Though it's a procedural change, but it's a big change. There are 3 amendments which came in this regard. One is about small business, private trust have been given a validity certification or validity extension up to 10 years from 5 years. This is
Small
a big
charitable
move.
trust.
Yeah, for charitable trust, NGOs. Second is regarding relief is that earlier the application form for the charitable registration was so complicated that sometimes the missing information or some incomplete or inaccurate information was leading to the cancellation of the NGOs or charitable trust from the registration. In that situation, they were unnecessarily or unwanted tax litigation was getting created, and the entire property created by that NGO was subject to tax at the fair market value. Now it is done away with. Even if the incomplete application will not be a ground for the rejection. This is a big relief. The third important amendment is about the reporting, where all the specified persons should be reported while filing the return or 10B form for the charitable organization. Now, specified persons definition is also narrowed down, and it will require to include only those substantial contributor whose contribution at a one go is either 1 lakh rupees or in totality or in aggregate over the entire year is about 10 lakh rupees. This will ease out the reporting threshold, and at the same time, the another important amendment which came is that the substantial contributors, relative and business entities are removed from the reporting compliance, which was there earlier. So these are the welcome moves as far as the NGOs are concerned or charitable trusts are concerned, which will reduce the administrative hurdles and it will increase the smoother compliances when they are impacting lives.
On a lighter note, some charitable organizations were telling they have stopped looking at the budget because whenever they look at budget, they have something more to comply rather than less. So certainly this budget was an exception to this.
True.
Last direct tax point, which I want to know from you, amalgamation, there has been a change. Why and what was the change and what is the need for that? Everybody was enjoying a fresh lease of 8 years. Why it has been taken away?
Yeah,
this is
because
certainly not welcome.
It's not a welcome, but it is at least giving a clarity, because otherwise it was creating a lots of havoc in the merger and acquisition situation. Because earlier the provision was not clear and therefore the people used to enjoy the benefit in the case of amalgamation. In general case, we used to see the business losses are allowed for 8 years. The year in which it is incurred plus 8 years, you can set off those losses against your business income. But when it was happening an amalgamation or demerger, there was a misconception amongst the people because of the no clarity in the law that we get fresh lease of life post amalgamation, and therefore the 8 years were counted from the date in which amalgamation was taking place. When I'm using the word amalgamation, it was of the private company, government company, even banks, or even a demerger of the companies. Now, from 1st April 25, this amendment is brought in, where they have very clearly defined that even if the amalgamation or demerger or corporatization of the partnership is taking place, the losses to be carried forward will be counted from the day the original entity has generated those losses. That means if A Limited is merging with B Limited, say on 1st April 25, and A Limited has incurred losses, say in 1st April 21, in the 2021 there is some losses incurred, then the amalgamated entity, that is the B entity, will be entitled to claim those losses only up to 8 years to be counted from AY 21-22, that is financial year 2021. So now fresh lease of life is not permitted. And this rule is now made across all M&A type of activities, whether it is corporatization of the partnership or demerger of the organization.
So certainly not a, I mean, some places we hope that there is no clarity so that business can go as usual. This is one such provision. We'll take up the last question and then we'll open it for the audience to ask the questions. So last question to you, Bhavesh. As far as the international tax is concerned, we've heard block assessment concept in the case of search. Now we are seeing block assessment in transfer pricing. What is this?
Okay, I know, but let me tell you, both are completely independent of each other. The way transfer pricing assessments are being done and accepted by the even the assessors is there is a typical scrutiny which which is undertaken by the assessing officer. For international transaction matters, the case is referred to a transfer pricing officer who is entasked with determining arm's length price only for the international transaction bit. So there are two parallel scrutinies which are conducted, one by the TPO for international transaction leg and one for the domestic transaction by the normal assessing officer. Now, for an international transaction leg, year on year, there were references being made by the assessing officer to TPO to conduct arm's length price for international transaction. And the need was felt that, those transactions are of repetitive nature, monotonous. Assessors have been offering same price range. They've been paying adequate taxes year on year. So it was leading to an administrative burden on the tax officers without resulting into any additional revenue for the government. So need was felt that, why scrutinize them year on year if they're offering the same margin, then why don't give them a block of 3 years that if the facts of the assessee remain the same, if the transaction remain the same, and the margin offered by the assessee also remain the same for the consecutive block of 3 years, then tax department would not want to assess them further. Once the first assessment is done, the next 2 years are deemed to be, they'll be considered as at arm's length, and there'll be no further questions asked by the tax officers. So it's a win-win proposition because tax officer also need not waste their administrative time scrutinizing the same cases, whereas from assessor standpoint, they need not be answerable to two different parallel authorities for the same assessment here, and giving the information details data for the same range of transaction. So a very welcome move. Administratively, procedurally, the way they set it up is assessee will have a right to apply for, there'll be a form which will be specified. Assessee will opt in for the regime that they want to be covered for a 3-year block. being satisfied, assessing officer will agree, and once agreed, the same margin range will apply for subsequent 2 block years as well. So it's a block period for which only one assessment is being conducted and accepted by the tax department for subsequent 2 years. Of course, it will lead to some ground level challenges, some practical differences, because what happens if there is an addition proposed to be made in the first year, it would automatically apply in the subsequent 2 years also. So what happens when the penalty is levied because of addition in the first year? Would the penalty also be automatically, it will be applied in the subsequent years, so on and so forth. But I think we'll have to see how, in what form and shape the forms are being prescribed. Another important factor to be noted is, let's say I as an assessee will have 3 or 4 international transactions, where out of which I only want to opt for 2 of the such transactions. I don't want to opt for a block period for remaining 2. So will the department allow me to opt in and opt out, for be selective in my choice and opt in only for 2 transactions and not opt for the rest of the transactions? So I think these are all the ifs and buts. We'll have to see how the form is rolled out. But at a macro level, welcome provision will reduce uncertainty, will reduce tax department's administrative time and hustle. So quite a welcome move.
So most of the time what used to happen is the transactions were same, but it was being scrutinized, and in the same way it was being followed. So at least it will avoid the duplicacy of the proceedings, is what I believe with this.
Absolutely. That's the intention.
So,
and also this
again,
aligns with the global best practices also, because even if you see globally, transfer pricing assessments or transfer pricing requirements only occur once in 3 years by and large. So this also aligns with the global best practices.
Correct. So it's again a welcome move. And with that, we've also reached the time by 4 minutes. I thank all the participants for staying with us, understanding and decoding the budget 2025. We'll take up the questions if any there are, and then we can close it at the end. In case there are questions, you can also write to us and we'll revert to you by way of email as well. I would request you all, In.Talks webinar, we keep on conducting these webinars. And for more such webinars, keep following the LinkedIn page of InCorp. I can see there's one question. Samir, you can take it up probably. It says, what is the change when it comes to the house property? There is one SOP which can be taken as nil value. Can you throw some light on that?
So it's a positive amendment in this budget, and that will be having a retrospective effect from 1st April 24. That earlier people used to get a deduction of self-occupation only for one house property. And if they were having multiple houses, the second house was going for a dim let out situation, unless owing to their employment, they were moved from one place to other. And therefore, they were getting exemption only in that specific situation. Now this condition is relaxed, and even if you are holding 2 houses without any reason, you will be enjoying the exemption of the self-occupation for both the houses. So this is a welcome move, and I think this will impact the realty market also in a better way. Positive.
There's one more question. It relates to MSME. For women entrepreneurs, any specific qualification required to avail funding?
The fine prints have not yet come, and once it comes, we may be in a position to highlight this. But the idea is that it is the MSME funding which is given for or allocated for the women entrepreneurs is with the purpose. So if it is a purpose-led situation, the qualification of running that business is itself has to be a condition, and there is not technical qualification as such required in my view.
If any participants have questions, they can put it in the Q&A option, which is available at the end. I can't see any other question. Okay, there's one question which says that the revenue which is foregone by government through raise in slab rates has government talked about any plans to fill the same? Bhavesh, if you want to take it up. This is talking about the fiscal deficit, I believe.
Yeah,
The
I
1
know.
lakh crore, 1 lakh crore statement which was given.
I think I don't think they have made any plans to recoup the lost revenue, but I believe in the new code that the expectation is it will be much more simpler, fairer, and lead to a much more larger level of compliance. So hopefully, with the expectation that trust-based approach that the government wants to adopt, people will be forthcoming and voluntarily paying up the due taxes, and that's how they expect to fill it up. But so to say, on record, they haven't prescribed any plan to recoup the lost revenue because of the slab amendment.
Certainly, fiscal deficit was the answer, because as far as the number is concerned, they have estimated that fiscal deficit will go down, and they've
Yeah.
given 1 lakh crore as a benefit by way of revenue being foregone. So yeah, one last question, we'll take it up. Others will revert over email. Samir, I think you can take this up. Any reduction on TDS on partners' remuneration?
No.
This was one of the dreams and one of the wishes, but unfortunately hasn't been fulfilled. So I think 194T, there has been no amendment. So whatever the provisions are, 1st of April 2025, all the partnership firms and LLPs have to, I think, comply with it.
Yes. Yes.
Affecting businesses at large, including the chartered accountants.
True.
Thank you all for joining on this In.Talks webinar on Decoding the Union Budget 2025. As mentioned at the start, new income tax bill has already been proposed. It is expected, as mentioned by Bhavesh, that it is expected on 6th of February. So just like GST was reborn, service tax VAT was phased out and GST was reborn in 2017. In direct taxes also, we will see something similar as and when the new income tax bill comes into the picture. So let's see what amendments come as far as that is concerned. But as of now, for financial year 25-26, finance bill has been introduced with reduction in slab rates and a lot of unnecessary compliances which have been done away with. So certainly a budget which was welcomed by and large everybody, and we hope to see better compliances, more number of participants, more number of people paying taxes with honesty, which will increase the tax base, I believe. And that is how the 1 lakh crore revenue which has been foregone should come into play, with Vishwas first and scrutiny later. I think with that, thank you all for joining the webinar. And for any updates, please follow the LinkedIn page of InCorp. Thank you.